Hey everybody, Dion Rabouin here, markets reporter at the Wall Street Journal. This is our special edition. We are unpacking today's PCE inflation report. Inflation has been the big theme in markets over the past, man, it seems like almost the past year or so. It's been really the number one topic that investors have looked to, the thing most moving the markets, the thing that's most motivating and moving the Federal Reserve, which we all know that's the big trade right there, what the Fed does. So we are looking into and unpacking today's PCE personal consumption expenditures report that just came out this morning at 8:30. The news showing once again PCE inflation is at the highest rate in 40 years, this time going back to 1981. Higher than, well, actually lower than expected, but still higher than the previous month. So inflation's still picking up, but there's a big but when you talk about that number. It's getting higher, but all the components within the report are telling us that this looks like we may have peaked out here and we could be going down, moving towards lower inflation in the future rather than getting those month to month to month increases in PCE. So I want to talk through what the PCE report is, what it said, what we learned from it, and what we can expect based on what we've seen from the market and what we've seen thus far from investors and otherwise the reports that we've seen. So we're going to get into all that, talking all about PCE, the personal consumption expenditures report, right here on YouTube. So let's get into it. Let's dive deep into the report. Obviously, the big takeaway, like I said, highest number since 1981. PCE inflation hasn't been moving this fast since 1981. That's 41 years ago. But we saw, if you look at the core numbers and the number that takes out food and energy prices, which historically are very volatile, they move around a lot. And so to really see the core trend of where inflation's moving, the Federal Reserve and economists like to look at that core number. And that number shows that inflation actually slowed down from February in March. So inflation actually slowing down on the core piece of the CP or the PCE, excuse me, and starting to maybe move lower. Now, the big but to the but is that while inflation does look like it's slowing down, it's not slowing down at a super fast pace. The month over month number was 0.3%. That was the same as the previous month. So we're hitting that peak where inflation's not picking up super fast, that we're slowing down, particularly on the core number. And that's what economists really pay the most attention to, especially those economists at the Federal Reserve. Also, some good news within the report. Personal spending was up 1.1%. That means that folks are going out, spending money, they're buying things, they're continuing to not be pushed out of the market by inflation. They're not saying, oh my God, things are too expensive, let me just pull back on what I was doing, stay home and not go out. We did see more spending, and that was well above expectations. The but to the but to the but, the core income, personal income was only up about 0.5%, well below the overall rise in inflation. And that's telling us again, consumers are still spending. They've got big savings gluts put away at home in their savings accounts so they can spend, but their incomes aren't going up fast enough to keep up with the overall pace at which prices are rising. So we saw that again in March. That's not a good sign, because when you get prices rising faster than incomes, faster than folks are making money, that can lead to stagflation and some of these longer term inflation things that can be a bigger problem. When we look out at the market, the S&P 500 right now, stocks across the board are down and in the red. But we started out the day, like I said, that report came out at 8:30 a.m. Market opened up at 9:30 a.m. and we went up higher for a little bit, and then right around that 10 p.m. time, you saw the market really just kind of sell off within stocks. Bond yields a little bit higher today. We are seeing some of what folks in the bond market call bear flattening, which means the curve is getting flatter. The shorter dated yields are rising faster than the longer dated yields, which means that yield curve is flattening out, going from this to kind of this right here, as investors price in a faster pace of rate increases from the Federal Reserve. We're going to dive all into that. I want to take a step back and talk about the big picture, right? So the biggest question that we thought to have answered with this report was, is the pace of overall inflation slowing down, or is it continuing to rise? Well, big picture, the headline number, it is still rising, and it's rising at the fastest pace in 40 years. But when you take out volatile food and energy, which can jump significantly from month to month or dive, when you strip that out and look at just the core, which is food, which is it's not food, which is housing, which is what people are paying for goods that they buy out in the stores, for going out dining, things like that. That core pace is starting to slow down and moderate. So yes, the pace of overall inflation is still continuing to rise at the fastest pace in 40 years, but when you get inside the report, we are seeing that things are slowing down. Again, I want to just remind you guys, this is a live stream. We are talking about the PCE inflation report, the Fed's favored measure for inflation. It's what the Federal Reserve and all those economists out there with their PhDs look at when they are calculating, here's what inflation's looking like, even though that consumer price index, CPI, is more popular among regular everyday folks. That's what most people look at. That's up there at 8.5% for March. The PCE, personal consumption expenditures, that's at only 6.6%. I'm gonna explain to you the difference and what those two mean a little bit later. But right now, just wanna get into the other big picture, which is the Federal Reserve, right? What are they thinking about this? And this doesn't give us any more information than what we had. This kind of confirms the information that we had. Inflation was spiking higher. It was moving consistently higher at a very fast rate, the fastest pace in 40 years. And that looks like it continued. You got, right now, one of the reasons that a lot of economists say that, okay, we think we've hit this high and now we're going to come down is because, first of all, 2021 inflation was during this period, right? When you look at January, February, March, that was a slower period of inflation. So it's a lot easier to get up higher and get those readings that are 7% higher, 8% higher. As we move into April, May, June, and obviously we're already in April, but we get the report for April in May. The report obviously comes the month after the actual thing that's being measured. So once we get that April, May, June, July, all those numbers were when the comparisons got a little bit harder because inflation was rising at a faster pace last year and it was coming off of a higher or a lower base for 2020. So those numbers are going to keep rising, economists expect, but the pace at which we're rising is going to slow down just because, let's say, for example, inflation was at a level of 10 in 2021. Well, now it's at a level of 12. And so 12 is still high, but it's not that much higher than 10. Whereas previously, we were looking at inflation at a level of 10 compared to a level of 5 in 2020. So that's double the pace in 2021, but then you move into 2022 and it's only 20% more. That's what's going to happen, start to happen over the next few months. We're going to get these tougher comparisons where inflation was higher a year ago. So what it looks like compared to a year ago isn't going to be as fast, but still a very fast pace. The other thing that we're seeing is a strong dollar. That's what we've seen consistently in the markets for about the past 4 months. Really, most of this year is a strong dollar, and we're looking at, some economists are calling for parity with the euro, as in dollar and euro worth 1-to-1. So those of you who've been thinking about a European vacation, now might be a pretty good time. Things are going to be getting a little bit cheaper for you. The big picture question is inflation going to come down? And economists say, based on what we've seen in this PCE report, based on what we saw in the March CPI report, it looks like that's what's happening. But that might not be the case. There are reasons that we could see inflation continue to rise higher. The big one has been consumer expectations of inflation. We saw the New York Fed's survey of consumers show us that consumers expect 6.6% inflation. That's the highest since they began taking that survey in 2013. Consumers are saying we expect inflation to be well above what the Fed says they expect inflation to be. We expect it to be well above what it normally is and continue to grow, to rise higher. That despite everything the Fed has said, that they're on the case, that they're going to be raising rates, that they've got what it takes to choke off inflation and interest. The market also seeing that and expecting that inflation is going to be higher for a longer period of time. When you look at the 10-year break-even rate, when you look at 5-year forwards and break-even forwards, those are showing that investors expect inflation to be at least 3% over the next 10 years. When you look at that 10-year break-even inflation rate, That's the highest that that rate has been since they started tracking it. Now, they only started tracking it in the early 2000s, but that's still the highest that rate has ever been. So the market making very clear it expects inflation to stick around for longer. That may mean that, yes, we've peaked here with this PCE report and things are going to start coming down, but the market is saying even over the next decade, we don't expect the Fed to be able to get inflation down to its 2% target. That's what we're seeing in the market. That's what we're seeing from consumers. That's going to have to change, and the Fed's going to have to be a big part of changing that with raising rates and with their forward guidance. A big factor in that has been the war in Ukraine. As this war has lasted a lot longer than I think a lot of folks expected that it would, and has just continued on with no end in sight, well, the drag on prices coming down for oil and wheat, that's going to continue as well. So oil prices spiked up over $130 a barrel. We've seen them come down from that, but they're still holding in at that level above $100 per barrel. That is a very important level, and as long as oil prices stay above that, you're going to see prices at the pump stay elevated, and that makes everything more expensive. Everything gets delivered on trucks, from ships, airplanes. Those things all rely on some form of oil, and as long as the price of oil stays high, the cost of all of that gets factored in to all of those different things. Anything that you need to have shipped to a grocery store, to your house, to the store, the neighborhood store where you shop, that gets more expensive because transport costs are more expensive. You've also got COVID lockdowns in China, which have further embroiled some of these supply chain issues, as well as shut down manufacturing. If you're locked in your house because you can't go outside because of this COVID outbreak, well, you can't do your manufacturing job. You can't produce those products that we need here in the US. And the Chinese government says, that's too bad. We're locking people down because we want to stop this COVID outbreak by any means necessary. So that is further slowing down supply chains and manufacturing across the world because China is such a big hub for all that. That makes prices higher. If I know that you can't get your stuff produced over here at that cheap rate, I'm going to raise my price and say, hey, you know what? I got a lot of business coming in here, a lot of folks looking for a new supplier. My prices just went up. And because it's going to cost me more to do business, that's just keeping prices elevated and moving things higher. So again, we've seen the war in Ukraine, that COVID outbreak in China, as well as housing prices rising at double digits continued here in the US. We got a bunch of housing data last week, and all of it pretty routinely confirmed. Homes still rising 15 to 20%, 30% in some parts of the country. That's home prices, as well as mortgage rates at 5% and over 5% at this point. And that's just keeping prices elevated. So you've got a number of these different things that are weighing on the outlook for this price pressure to cease. Again, want to remind you guys, we are here doing this big PCE breakout. Usually, you know, we summarize the whole week and I talk to you about that, but today it's all about PCE inflation. It's all about what's going on in the inflation, in the world of inflation prices, and how that's going to impact the Fed. We've been talking about how the expectation is for economists, or the expectations from economists, that we have hit the peak here and we're going to start coming down, but the market's showing that we expect to come down, but at a much slower pace than expected. The other big piece of data we got, because a lot of PCE data you could have pulled out of the GDP report that came out yesterday. Today we got the employment cost index, and that was at the highest pace in history, a record high. And that's concerning for economists because wage inflation is stickier, as in it's harder to get rid of or harder to remove than other kinds of inflation. Once consumers start to, or once workers start to get used to getting raises at a certain level, they're not going to want to go back to that previous level. I mean, think about it, your job. If you get a 5% increase this year, you're not going to want a 3% increase next year. Right, you're going to want a 5 or a 6% price increase on your pay, because you say, hey, I didn't do a worse job this year. Why should my bonus or why should my raise be lower than it was last year? On the same token, if you took a job last year and someone's trying to lure you away, well, you're going to need more money to take that new job after you just got more money from the previous job that you took. So again, all these things are a big part of the report that we got today. That employment cost index, that might be the piece of data that's really most concerning to the Fed. And I think the thing that most people are going to be talking about as you talk about takeaways from this PCE report. want to just really quickly explain one thing, and that's how inflation is measured. You know, you get these acronyms, PCE, CPI. A lot of folks are like, all right, what is that, inflation? Yeah, PCE and CPI are measured differently. One of the big things is that within PCE, it accounts for substitutes. So if I've been buying filet mignon every month for the past 12 months, and now the price of filet mignon has reached this level, and I say, hey, you know what, I'm gonna buy ground beef. In the CPI, that's all the same. You bought beef. In PCE, it accounts for the difference between that filet mignon and that ground beef. And it says, okay, consumers switch from filet mignon to ground beef. That means inflation's not moving at as fast a pace as it was. So that's a reason to keep an eye on this PCE report that we got today. Because it does break out inflation a little differently. Inflation is all just a matter of how much prices are rising for housing, food, gas, all the things that you buy, consumer products, when you go to the store, how much does that cost? So the other big piece of this is Fed expectations. Like I said, that employment cost index number that we got today could worry the Fed, and that could be something that a lot of people are saying, hey, look over here, this inflation may be stickier, you guys got to go at a faster pace. Market's already pricing in a 50 basis point increase for this month. That's twice as fast as what the Fed normally hikes rates at, and expecting a 75 basis point increase in June, 3 times as fast. After we got this report today, expectations for Fed increases went up across the board. So obviously this is telling the Fed there's more work to do. It needs to be done quickly, and you guys better get on it. Like that's gonna do it. I think we've covered everything that we came to talk about in this PCE inflation report today. I want to thank you guys for tuning in and being with us here on Market Takes. I am Dion Rabouin, markets reporter for the Wall Street Journal. And we're gonna do this again on Monday. We will be right here talking to you guys about what to expect for the week ahead and what, kind of breaking down what happened last week. So join us again next week on Monday when we do this, the live stream again. I want to thank you guys for tuning in. I've been Dion Rabouin. Appreciate you guys, and I'll see you on Monday.